Good morning. How do Fed rate cuts affect CRE financing? Well, what investors, developers, and business owners in West Houston need to know is when the Federal Reserve cuts interest rates, the commercial real estate or CRE world reacts instantly. Whether you're buying an industrial warehouse in Katy or refinancing a medical office in Fulshire or investing in a retail center along the Grand Parkway, Fed policy directly influences your cost of capital, deal structure, and long-term returns. And here's what every investor, business owner, and CRE developer needs to understand. Number one, lower rates reduce borrowing costs. When the Fed cuts its federal funds rate, it basically indirectly reduces the prime rate of offering, so prime rate. It likely also has influence on SOFR-based loan rates, as well as SBA 504 and 7A pricing because they're tied to prime, and bridge loan coupons, as well as DSCR loan rates, and is particularly this item as well, construction financing costs. So lower borrowing expenses mean higher cash flow and stronger debt coverage ratios, which help marginal deals finally pencil out. We've had a lot of construction pipeline that's kind of on the fence, so hopefully that helps. In West Houston, where cap rates are still more attractive than Austin or Dallas, rate cuts often unlock new acquisition demand, especially for industrial and retail. Two, cap rates tend to compress. Lower rates create more liquidity in the system and as well more buyers. More buyers equals more competition, and more competition equals lower cap rates. This is especially true for industrial, including IOS sites, neighborhood retail centers, and medical office buildings, but also single-tenant triple net assets. And don't forget about flex and distribution spaces. Investors seeking yield often compress cap rates faster than the Fed cuts them, which is why acting early in a rate cut cycle creates the biggest advantage. Number three, development becomes more attractive. So rate cuts can reduce a lot of aspects of a transaction. So construction loan interest is going to decrease, carry costs decrease, debt service during lease up will increase, and there's less refinance risk. So rapidly growing markets like Katy, Fulshire, and Brookshire, rate cuts often trigger new industrial development, as well as retail expansions and build-to-suit projects. In West Houston, we're looking at a lot of office repositioning and redevelopment. Mixed-use plans pencil out better, and rate cuts basically just equal cheaper capital, which is more ground-up activity, more construction. Number four, refinancing windows open up. So a rate cut cycle is primed to refinancing out of bridge loans, exiting higher interest DSCR loans. And if you're in a floating rate instrument, you can reset your floating rate debt to market. You can improve your cash flow via longer amortization schedules, and you can pull out equity through cash out CRE refinancing. So if you bought somewhere between 22 and 24 at higher interest rates, a rate cut cycle is imminent and it should be able to help you. Number five, buyers gain more purchasing power. So when rates drop, DSCR increases, loan proceeds increase, and required equity also decreases. And this boosts investor capability and allows business owners to purchase rather than lease, especially for owner-occupied SBA 504 and 7A deals. So here's the bottom line. Rate cuts create opportunity. If you're an investor, a developer, or a business owner in West Houston, now's the time to start thinking about these things. Evaluating your refinance options, analyze acquisition opportunities, lock in cheaper capital early, run DSCR proceeds in scenarios, and prepare for cap rate compression. Now is the time when smart operators buy. If you want to talk more, I'd be happy to. HoustonRealEstateBrokerage.com is my website. Thanks for your time. Have a good day.